Use this trick to pay off your home in 5 to 7 years. Have you been seeing ads just like that? I've seen a bunch of videos and ads and claiming you can use this trick to pay off your home in 5 to 7 years using the HELOC method. And it seems like these start to come around when the market starts to turn a little bit. So I thought it might be a good idea to dive in and take a look and see if this actually works. And some of these videos have millions of views. In fact, one that I was looking at had 6.5 million views. So people are definitely interested in it. So hey guys, I'm Christian. I've been in the mortgage industry since 2001 and I've worked pretty much every position, including being an owner. And in this video, we're gonna dive deep into this to see if it actually works or not. If you know someone considering one of these options, please make sure to share this video with them so they can decide for themselves if this actually works or not. So a home equity line of credit is very similar to a credit card, but instead of getting a card, you actually get checks. So you have a limit and you can write checks up to that limit, and then at the end of the month, the statement comes and you have to pay at least the interest, but you can pay more if you'd like. So here's how they say that it works. So you take and you get a home equity line of credit for the full amount of the mortgage. And then what you do is you take your full paycheck and you deposit it into the home equity line of credit. So you kind of use the home equity line of credit like it's your bank account, right? So you deposit your check into there and you pay your bills out of that account instead, and that pays it off in the 5 to 7 years. And then they say that with the other bills that you have, you pay those with a credit card. When you put a charge on a credit card, typically don't pay interest for the first 30 days. Now, this is true. So you don't pay interest for the first 30 days, and then once the credit card bill comes, you pay the full balance out of the home equity line of credit. You put your paycheck into the home equity line of credit, that satisfies the mortgage, and then you pay the credit card payment out of the home equity line of credit once the bill comes and you pay that in full. And the idea being that the interest on a home equity line of credit is based on the average daily balance. And so when you open up that line of credit and you deposit your paycheck in there right away, it lowers that average daily balance, and so we're paying interest on a lower amount. And they claim that it works even if the interest rate is higher on the line of credit than your fixed mortgage. So let's take a look at it. The average rate on a home equity line of credit right now, and this is according to Bankrate, is 7.3%. So I looked up a couple of averages. I figured it would be best to just use that so we can see for the average person, does this work? Now the average rate on a mortgage, this is based on Freddie Mac's survey, is 6.33%. So that's what we're gonna use on comparing the fixed. Now the median home price in the US is $454,900. And that's according to the Department of Housing and Urban Development. Okay, so let's say you buy a home at $454,900 and you put 20% down. That makes your loan amount $363,920. Now, if we have an interest rate at 6.33% on that 30-year like we talked about, that makes your principal and interest payment $2,259. Now, with taxes and insurance, we'll use about $2,500 for the total payment. So when your mortgage statement comes in the mail, you start with a balance of $363,920, and then you have interest of $1,920. That's based again on that 6.33% interest rate. You have your payment of $2,500, of which about $240 goes to taxes and insurance. That makes our balance after the first payment $363,580. Now keep in mind, $340 of that is going to principal, right? And so that actually pays off the loan in 30 years. It's a 30-year fixed. It pays off the loan over the course of 30 years. Now let's look at the HELOC method. The HELOC method claims if we take our whole paycheck and we deposit it into a line of credit, right? So we open up a line of credit for the same dollar amount. That's the $363,920. So we open up a home equity line of credit for that amount. We take our paycheck and we deposit it in there. Now the median household income for the US is $70,784 per year, right? So that equates to a take-home pay of about $5,000. We're gonna use $5,000 just to make math a little bit easier. So keep in mind we have the $2,500 for our mortgage payment, right? So that's the principal, interest, taxes, and insurance is $2,500. And let's just say for figuring this, $2,500 is what it costs for us to eat and pay other bills, right? So $2,500 total, so 25 and 25 equals 5,000. So yes, we're using the full 5,000 for this scenario. So let's see if it works. So you go ahead and you open your line of credit for that amount after you put the 20% down, right? You move that full loan balance from a 30-year fixed over to a line of credit. That means your balance starts at $363,920. You deposit your full $5,000 take-home pay. That takes the balance to $358,920. And then of course you pay all of your other bills on the credit card, which defers that interest for the first 30 days, right? There's no interest on the credit card for the first 30 days. And then you get your home equity line of credit statement after the first month. So let's look at this. After the first month, the interest on the home equity line of credit, keep in mind the balance is $5,000 lower because we're trying to take advantage of the lower average daily balance, right? But with that interest rate, the interest on there is $2,183. And then keep in mind, we've got to pay the $2,500 credit card out of the HELOC, okay? And then of course we have our taxes and insurance, which is about $240, right? So we've got to pay that as well. That makes our new balance $363,843. Did you notice that that balance is actually higher than the 30-year fixed? So if this rate of 7.33 were a fixed rate and you did it as a home equity line of credit, but it was a fixed rate, it would actually take 46.5 years to pay this off rather than the 30. But wait, that's not 5 to 7 years either, is it? It's much longer. Even though we're paying the interest based on a lower balance, $5,000 lower in this case, because that interest rate is higher, it's still gonna cost more in interest. Now, here's another way that sometimes I've seen it presented, and I had someone actually present it to me this way, but let me know in the comments below if you catch the strategy here. You open your HELOC, of course, the balance $363,920, right? You pay the full $5,000 take-home pay into that HELOC, and that takes the balance to $358,920. And then you pay your $240 for taxes and insurance, and this pays it off in 8.3 years. That math checks out. So it works, right? But wait a minute, did you catch it? That's assuming a person has zero as far as other bills go. No utilities, no food, no fun, nothing, right? That assumes that there is zero. And so if you had bought the average home and you put 20% down and you put it into a home equity line of credit and you had the average take-home pay of someone in the United States and you put all of that towards your mortgage, you would pay it off in 8.3 years. So, okay, we'll play along with that for a moment. Let's say we take that $2,500 and apply it towards the fixed rate mortgage, which would be better. Well, it turns out that if we do that route instead, we would pay it off in 8.1 years. So it's still better off to do it that way and putting additional towards the mortgage as opposed to the home equity line of credit. And keep in mind, if you take out a home equity line of credit, that rate's not fixed, it's adjustable, and it's fully adjustable. In fact, every time the feds get together to raise rates, guess what happens to that? It goes up. So if they raise the rates half a point, it goes up half a point. So it's really risky to have all of that balance on a home equity line of credit, right? And at some point in the future, yes, the feds will probably lower the rates in order to help the economy, help stimulate the economy. But when that is, who knows, right? And if you're gonna have this mortgage for many years, it can be really risky to have it completely adjustable, right? So the real way to pay off a loan quicker, and really the only way, is to make payments to the principal only. Now there's a couple of different options for doing this. Bi-weekly is a really popular method. That's where you pay half of the payment every 2 weeks, and so over the course of the year you end up making 13 payments instead of 12, and that last payment, the full amount, goes to principal, so that's a way. Another is if you send additional payments in with your mortgage, right? So if you send an extra $100, $200 per month, that will go directly towards your mortgage. You got to make sure you specify that it go directly to principal, because if you don't, it will prepay a portion of the next payment, right? But if you do that, then those two ways will help you to pay it off quicker. But there aren't any magical ways, and if it seems too good to be true, it probably is. And so guys, if you have anything else like this you want me to check out, please make sure to drop it in the comments below and we can check it out for you. Also, if you want to learn more about home equity lines of credit and how they work, go ahead and watch this video right here. It'll tell you all you need to know. Thanks guys for watching. We'll see you on the next one.